Hi, I'm John from Folla Capital, and this short is about the Capital Quadrant. And this falls under the no one ever tells us this stuff category. So here we go. So the Capital Quadrant is represented by these two axes that you see here. On the horizontal axis, we have domains, public and private, and on the vertical axis, we have primary and secondary markets. So why is this important? Well, most of us are really familiar with the upper right, the stock exchanges. Most of us invest in companies through the stock exchange. But what we're actually doing in the stock exchange most of the time is we're buying stock or selling stock from someone else that either has the stock we're buying or we're selling the stock to. It's called a secondary market. So the stock exchanges are regulated by the SEC, and we all know about stock exchanges. Most of us are familiar with stock exchanges and how they work. But one thing about that upper right quadrant, when we invest or buy stock in a certain company, we're actually not, our money doesn't go to that company. Our money goes to the person who's selling the stock that currently owns stock in that company. So the money we invest in the stock exchange, in most cases, does not go to the company. How does that happen? Well, it happens in the primary market, public market, in this quadrant. So this is where initial public offerings occur. This is when a company first goes public and is for the very first time, selling its stock to the public. But spoiler alert, most of the time, Wall Street banks are managing that process. Underwriting banks and investment banks actually buy that stock in bulk from the company, and that's how the company gets its initial cash most of the time. There are some exceptions. And then that underwriting bank actually turns around and sells that stock out of inventory, their inventory, to the public on the exchanges and facilitates that process. So that's an initial public offering. The other thing that occurs in the public markets as a primary offering is those companies that are already public might need more capital. So what they do is they issue more stock and follow the same process I just described to get it out to the public. The other thing that happens here is the bond market, right? Municipal bonds, corporate bonds, and debt offerings are done on the public markets, and those are typically primary offerings because the money that's raised either goes to the government entity raising it through bonds or to the corporations that are using bonds as a way to raise capital. In the lower left, we have private placements. This is private domain primary market. What that means is small businesses or large businesses, for that matter, that are not public raise capital in this quadrant. They do so through something known as exemptions. This is there's different kinds of exemptions. There's 6 general exemptions. There's 2 levels of Reg A, 3 kinds of Reg D, and a new one called Reg CF, which I'll get back to. But this is through these SEC exemptions, capital is raised by private companies. The term exemption is used because the SEC says that under certain conditions and following SEC rules, these companies raising capital this way are exempt from the requirements of going public. So this is where angel capital raises occurs, venture capital occurs in this particular quadrant. The last quadrant is the secondary market for private companies, and that's the land of mergers and acquisitions, or M&A. This is usually driven largely by venture capital and private equity. This is where big companies buy smaller companies. This is where 2 companies may merge, funded by a private equity firm, or a private equity firm or a venture capital firm might actually buy a company for whatever reason they want to buy. Their money is private. It comes from investors, and they're using that money and making investments in this secondary market for companies. And here we're talking about buying companies and combining companies. So this is the Capital Quadrant, and capital operates in each of these 4 quadrants differently, and different people participate in each of these markets. And for most of us, we're in the upper right. Most of us in this country are familiar with how the stock market works, but the other quadrants are less familiar to us. But here's a couple of fun facts you probably didn't know. First of all, 99% of the companies in America are private. Let me say that again. Almost 100% of the companies in America are private, not public, which means that, 1% of the companies that we get to buy and sell stock with only represent 1% of the companies in America. And the other thing is 11% of the U.S. households meet the definition of accredited investor. Accredited investor is a term used to describe a wealthy household or individual or entity. And usually there's a SEC definition of it, but generally what it is, it's $1 million in net worth, not including the equity in your primary home, or you make over $200,000 a year. There's more to it than that, but that makes you an accredited investor. And when you apply that definition to American households, only 11% of American households and entities fit that description. So that means that 89% of us that are non-accredited get to invest, but we only get to invest in 1% of the businesses in America, while 11% of the people in this country and entities get to invest in 99% of the private businesses. Well, how do they make money? The people that operate in the private primary market. So these investors, angel investors, entities that invest in private companies and venture capital, typically invest through a process. Private placements is typically what it's called. And the company can do one of three things. The first thing they can do is eventually go public. That's typically the goal of a lot of companies, is to go public. But more likely than not, the second thing they can do is actually get acquired. And acquisitions occur at a much exponentially more rate than companies that go public. The third thing that company can do is go out of business. So that can be highly likely, especially in startup world. So a company that starts in the lower left, a private company, either sustains itself forever, but if it's investor-backed, typically the investors need one of the first two things to happen, because that's how they get their return. You know, the good news is that in 2012, President Obama signed the Jobs Act and created one of those exemptions, the newest one called Reg CF. And what has that done for us? Well, that has allowed the rest of us, the other 89% of us that traditionally cannot participate in a private placement, and it's allowing us to do so, and that's the good news. There were some exceptions, for the record, where some non-accredited investors could invest in a private placement. 9% of those folks were able to participate in a couple of these exemptions that allow limited participation. So thank you for your time. Hopefully you learned something. We'll see you on the next short.